All right. Hello, and welcome back to LTC Heroes Live by Experience Care. My name is Peter Murphy Lewis. I'm your host. I'm excited because I have a repeat guest, Michelle Gramoglia. She's the president and CEO of Woodland Pond at New Pulse. She was on LTC Heroes back in July of 2021. Michelle, welcome back to the program.
Hi, Peter. How are you?
Good. I'm excited to have you back. This is a unique topic because you and I had a chat, I want to say, after our first interview, maybe in October or November of 2022. And I said, "What do you got on your plate?" And you said, "Well, I've got this presentation that I just did." And I said, "Walk me through it. Tell me, Michelle, what you presented, why it was important for your organization."
So, Woodland Pond, when we first, well, even before we opened, so Woodland Pond was conceived in the early 2000s, and then ultimately the feasibility study was done in 2007. We came online in 2009, which was basically just at the time of the Great Recession, so to speak. And of course, like all senior living or long-term care communities that are based on the entrance fee model, our model is really contingent on the housing market. So we were very challenged financially. And so we had a really rough start. And it took a lot of creative thinking and a lot of years for us, first of all, to achieve stabilized occupancy. It was a really hard start for us. And we have a great story to tell because despite a hard start, we actually really found our footing. And so much of it came through harnessing the power of our marketing team and the fact that money motivates. And so I was asked to speak at a national conference that was put on by Ziegler last year. And I wanted to share the presentation because I think that there's a lot of power in the presentation that we put together and really simple stuff. And when we were presenting at the conference, I was surprised at how many executives in the room looked at what I thought were really simple concepts as if they were, kind of, really new and exciting. So I thought maybe we could talk about it today.
Wonderful. Before I start sharing my screen, and hopefully everyone can go over to YouTube or LinkedIn and actually watch it as we go through this. I wanna ask you how you came up with the name. I'm looking at my second screen. It says "Turning the Titanic: Using a Strategic Marketing Commission Structure to Improve Long-Term Financial Outlook." So tell me about turning the Titanic.
It came to me in a board retreat actually that we were having probably in around the 2016 timeframe. And the reason that that is sticking out to me is because 2016 is the year that Woodland Pond actually went standalone. We previously, well, we had been opened under a sole corporate member in a large healthcare system. And they were going one way, and we decided we needed to kind of go a separate way. We would really wasn't a good fit strategically to be part of a healthcare system anymore. And when New York State approved that de-affiliation, our board kind of went from being a passive board into being an active board. And as you'll see in our slides, they needed to really do a lot. Not only did we have a rough start financially from the beginning, and it took us a long time to get to stabilized occupancy, you can kind of buzz through some of these things. We didn't even have a strategic plan. We didn't have bylaws. There was nothing. Everything was at the parent level. And we knew, we had to make changes to really kind of shore up a financial outlook that hadn't really been great from the beginning, and then a very slow fill. So, but we knew that it wasn't going to be quick. And I really kind of envisioned, my son is 13 now, but at the time, just obsessed with the movie The Titanic and the story of the Titanic. And I really kind of envisioned we need to make changes to something, but it's going to be like turning the Titanic. This is something that's going to take us time to do. So we're going to effectuate changes and through a strategic plan and strategic vision, but we can't expect changes overnight. And I really wanted to impart that in my conversations with the board so that they weren't, sort of expecting that we were going to be able to snap our fingers and things were going to change. And you'll see as we go through the slides that this does take time, but it's gradual.
Tell me about kind of the setup. Give me a little bit of the context from the first two or three slides, and then let's move into where you start explaining how you got there. And I'll interrupt you and ask you about the hiccups and how hard it was for you to learn how to do this as well.
Yeah, I mean, really quickly, just buzzing through these, we were 100% debt financed back in 2007. We closed. We had 5 tranches of debt. It was $117 million. Again, no guarantor at the parent company level. So Woodland Pond was fully on the hook for this with no equity in the deal, put into the deal. At the time that the feasibility study was approved by all the powers that be at the time, it showed that even at stabilized occupancy, we were still going to be 14% reliant on turnover entrance fees. So even on our best day, way back when this feasibility study was approved by everyone, it said we weren't even going to be breaking even from revenue. So that's kind of a scary thing. And I came into this after all of that was already, kind of signed, sealed, and delivered. But that's the financing that was, expected at the time. So that's a little daunting. Then we had construction overruns of $7 million. We had a 72-month fill, actual fill to stabilize occupancy versus 30 months that were projected in the feasibility study. So many things sort of mounted against us. You can go to the next slide. And so we opened in 2009. It really took us until 2016 to fully achieve stabilized occupancy, and that is at the same time when our organization went standalone. So it was in 2017 that our board, now having had established bylaws, which was the first step, and taking its active governance powers, that we decided that we needed to adopt a strategic plan. And of course, it had many different pillars, and it still does. But of course, one of those things was to achieve financial stability and financial growth. And so you can see here that we had a number of things in that strategic plan that were really critical from a financial perspective. And I would encourage anybody that is in leadership at a senior living community, if you do not have a strategic plan, it can seem like it's daunting. We did not have one. We did not go to a consultant to create one. I sort of thought about how do we want to create a strategic plan. Our board thought about how did we want to structure it. And I'd be happy to take that offline with somebody, but you can definitely do it. It does not have to overwhelm you. It can be a simplified process, but it's really important to have it. We can talk about that in a totally different podcast. But we had, just some really important things. We wanted to make sure they have to be measurable. I think it's really important, but we wanted to make sure that we were really trying to mitigate risk and help ourselves financially. We still had variable rate debt at that time. Priority was we wanted to make as much of that fixed rate as we possibly could. So that was a very early strategic goal of ours when we adopted that plan. That got accomplished very quickly. We wanted to try to identify if we could access safety net cash, is what we were calling it at that time. And we did that through establishing with a local bank a line of working capital credit. We wanted to continue to run lean because that was something Woodland Pond was very good at then and we're very good at now. And we know that because we selected an audit firm around that time, or maybe a couple years in from when we went standalone, that has many continuing care retirement community clients. And as part of our engagement with them, they give us benchmarks to our peer groups and to CARF accredited CCRCs. So we know how Woodland Pond is ranking against our peer groups, so single site CCRCs in the Northeast, and then CARF accredited CCRCs. So every time we get our audit package, actually we just got it this week, we know how we're ranking. And those critical ratios are part of our strategic plan and part of our financial reporting package. So it's really giving yourself those tools to make sure that you can successfully manage and adequately measure the things that you're doing as well. But the really critical things and the purpose of the presentation today and harnessing that power of the marketing, maintain strong independent living occupancy, reduce our reliance on 90% refundable contracts, because when that feasibility study was first created, it was 100% 90% refundable contracts, which is very, very challenging for any community to be able to maintain, So we were already highly leveraged, essentially. We already knew that we were going to be not breaking even from a revenue and expense perspective, and everything was contingent on 90% refundable contracts. That is a stressful position to be in as an operator. We wanted to maintain a strong incoming entrance fee pool with aggressive pricing and low refundability contracts. We wanted to reduce our refundable fee liability. We wanted to increase our deferred revenue because that's essentially like a future revenue stream. and we wanted to grow our days cash on hand, which is one of our covenants for our debt. So these were all things in our strategic plan that we identified in 2017 that were really critical. And we measure these in a
Mich-
1 and 5 year rolling period of time in our strategic plan.
Michelle, I have a couple different follow-up questions. I'll ask all of them, and you can field whichever one you want in what order. Uh,
Mm-hmm.
what was the hardest part of doing your first strategic plan? Was it? I guess, and I'll leave that open ended. And then my next two questions are, of those kind of goals that you have there, which one was easier than you thought it was going to be, and which is the one that was actually a bigger challenge than you thought it would be?
So the hardest part about adopting and implementing our very first strategic plan was the fact that on our board of directors, which is fully volunteer and comprised primarily of at any given point in time, of course, the composition changes, as board members turn over, was the fact that we have a lot of academics on our board because we're in a college town. One of the state universities in New York is here in New Paltz. And so it became a very academic exercise. And I'm a finance person by background. So for me, I'm very cut and dry, very measured, and so there was so much discussion about, the exercise and so there was just some philosophical discussion. So it took us a while to kind of get our feet under us about the actual process. And that's kind of why I was sort of tongue in cheek saying it doesn't need to be a really extensive process. You can really cut it up and measure it out. So that was our biggest challenge. And once we kind of figured out how do we want to go with this, it really became easy. And I engaged my department heads on it right at the beginning because I needed them to have ownership in it, and then it was kind of a piece of cake. Um, in terms of these things, what did I think was sort of easier than I expected to accomplish? Getting that line of credit actually ended up being easier than I expected. Because our credit really, it's not technically credit when you're talking about a corporation, but because we have such a thin financial, I didn't think that there was any chance that we'd be able to establish a line of credit. So that actually was easier for us to accomplish than I thought it was going to be. And I attribute that to the fact that around the same time that we were able to establish that $1 million line of credit, we had switched from a large national bank or maybe international bank that everyone would recognize the name of. We moved to a regional bank. They had been wooing us for some time. It's a 150-year-old bank here in the area, very strong banking statistics. But I think we talked last time about how I like to do community partnerships. They really wanted our business, and it actually worked out really well. They were able to underwrite us fairly. There was no special deal made, but they were able to get comfortable with our financials at that point. So that actually was easier for us to accomplish than I thought it was going to be. And in terms of what was harder here than I expected it to be, in order for us to go from the variable rate and adjustable rate 5 tranches of debt that we had to get to fully fixed rate debt, it actually took us 2 refinancings. So we had once refinanced the debt in 2014 prior to adopting the strategic plan, and we got some of the variable rate and adjustable rate debt out of the picture, but we had to refinance again in 2017 to get everything else out, and we were finally fully fixed rate in 2017. So that costs a lot of money to refinance that debt, so that took us 2 refinancings. So that was a little bit more challenging than I expected.
Thanks for sharing that. I'm glad that you brought up our first conversation about community partnerships and strategic partnerships because it's one of the most visited blogs on our website. We wrote up an article on that, and I'll put it in the show notes. And I'm glad you brought that up because that was a big one.
Good. So, one of the things that I've talked about in my presentation, and I've actually been asked to talk to a couple of communities specifically about this, is in order for you to be knowing where you're going at any given time, one of the things that I have found is that you're projecting, and I say you need to project like a boss. Because if you're not doing projections, again, I'm a finance person that's now an operator. I don't know how you're knowing where you're going. So I created a very simple projection model, and you can't see the columns to the right here because they're not here. But basically, this is a month by month Excel, file that takes your accrual-based P&L, profit and loss schedule, and then reconciles for cash activity down at the bottom. And you can see here, you've got basically cash. I don't know how other communities operate, but at Woodland Pond, we essentially have to know what our cash position is going to be at the end of every month. So, and we have cash covenants, liquidity covenants as part of our, debt agreement. And then of course debt service coverage ratio. But cash is king here at Woodland Pond. We need to know where we're going to be so that we can pay refunds, pay our bills, and things like that. So we're constantly keeping projections. That's what our board is looking for. Our bondholders are looking for that. The state is looking for that. New York State is very heavily regulated for our product line because we offer an insurance product, an insurance-like product. So we have to be doing this. Anyone that is listening to this podcast, if you would like our projection model, it is so simple. I will share it with you, and I encourage you to be keeping projections. Very, very important. All right, now the meat of this. So I said to myself, how are we going to do this? How are we going to accomplish this? We know we need those entrance fees. We know from day one, even when we were stabilized, we are going to be 14% reliant on entrance fees. But we also know that we don't want to just have 90% contracts and be so heavily reliant on those. So I'm saying to myself, how am I going to do this? I'm going to harness the power of the commission dollars for my marketing team to accomplish our strategic goals. To me, that's a no-brainer. And as I said, when I sat in the room with all of the executives that were here at this national conference last March and was explaining this to folks, it seemed like they were surprised that this was, something that anybody would dare do. But I thought it was great. So let's.
Why were they surprised? They didn't think that you could put in incentives. You didn't think that they didn't think that people would be motivated by incentives. They didn't think they could control their own destiny.
No, I think the concept of incentives is very commonplace. I think every community that has, the CCRCs, the long-term care communities that have, entrance fee models certainly are using, sales and commissions. But what you'll see is we change ours every single quarter, and every commission is not created equal. And it was that concept of reviewing and updating your commission structure every quarter based on the needs of the community that seemed to be remarkable to people as I'm making this presentation. And the fact that our marketing team is expecting to know that it's going to change, that seemed to be notable to the folks in the room. So a couple of important facts and things to note here. So I had already mentioned that when the community opened, we only offered 90% contracts. So that means that we would always be churning all the time. Very, very stressful. So in 2011, we added a traditionally refundable contract, or 0% after 4 years. In 2018, based on market demand, we added a 50% refundable contract. And I'm making it seem like it's easy, but in New York State, any change like this requires a full comprehensive actuarial study, which we have to get all the time for them, regardless, for the regulators. And then in 2021, we eliminated the 90% refundable contracts outright and replaced it with a 75% refundable contract. So now we currently offer a 75, a 50, and a 0% refundable. So one of my strategic goals was to reduce the reliance on the 90% refundable contract, and you can see that now we don't even offer it anymore. So that goal is inherently being met because we don't offer that contract anymore. Our life care fee is separate from our contract fee, and that's important from a refundability perspective. That's a nuance that some communities will understand and others won't. Very important. So then talking about, what did we implement as for our commission structure in 2017 as part of the strategic plan. So I've already talked about the fact that it draws on money as a motivator in sales. We revisit the goals quarterly, and we look at the 7 different items that we look at. We look at our inventory goals, our occupancy goals, our cash flow goals, our life care goals, double occupancy, contract mix, and covenant and critical ratios. All of those things go into this. I don't need to go into this. This was just a sample for that one particular. Oh, the formatting on here is a little funky. But if you were to look at this, and the formatting on here was a little bit more lined up, you would see that the commission, let's just look at the spruce line, okay, and pretend that these are lined up and you could actually see them. So the spruce is our smallest unit. This was the actual commission structure. This is a letter that our marketing team gets. So the spruce is our smallest unit. It's a 1-bedroom apartment in the building. That particular quarter, the marketing team would get a $500 commission on the 90% refundable, a $1,500 commission on the 50% refundable contract, and a $1,750 commission on the traditionally refundable, because we want them to sell the traditionally refundable contract, because after 4 years, there's no refund. So I'm aligning my team to want to sell the contract we want them to sell.
Amazing.
Money motivates. If you look at which contract here or which apartment style was offering the largest commission for that particular quarter, it was the cedar style. And that is because I had the most inventory in the cedar and they weren't selling. So the units that sold themselves at that time, which was the cottage, hardly had a commission. And every quarter we would do the same thing. Additional incentive, $500 premium if it sold to a couple. Every quarter we're looking at this, and every quarter the marketing team gets a new letter based on what we're trying to accomplish in that particular quarter.
I have a question around the alignment on your revenue team for sales and marketing. So when the sales knows what their commission structure is, do they have support when they knock on? Do they develop their own marketing materials so that they say, hey, like, here's what you get from the cottage, but let me show you about the cedar. How does that communication work? Because oftentimes there's some bickering between marketing and sales.
So we only have a 2-person team for everything. So our 2 people do it all. We do hire out the web component of it, but I've got
Perfect.
a director of marketing and I've got a marketing coordinator. And
So when your team, so when your team's that small, they get along because they both benefit from communication and coordination.
Yeah, I mean, that's it. Actually, when we were at the same conference, there was a statistic floated that if you're running your marketing and sales combined efficiently, the cost of that program in total, including their commission, salaries, direct mail, the whole thing, should cost you 4% or less of your operating expense side budget. Ours costs us less than 2%.
That's amazing.
And we're full with waiting lists everywhere.
Yeah.
So this was where I had said that we need to continue to run lean. We run very lean. So we've got the 2 people, and I do have an admissions coordinator in the health center that's also trained to support independent living admissions marketing if she needs to. So we run extremely lean, but they do everything in-house. They can, they have access to whatever they need to. But if you could just go back one slide, I just want to show you another component of their commission structure. So we also build in additional commission opportunities, and these will change. These typically change more annually though than quarterly. But you can see where I have DCOH measurement date. I'm giving them a bump or an added incentive at June and December there because I've got a day's cash on hand measurement date there. So when I'm looking at my projections, I'm looking and saying, where do I need my marketing team to be laser focused on generating additional cash flow? And that's going to be in June and December when I have a covenant measurement date that I need to meet. So that's going to be different based on each community, but you can really harness the power of these marketing teams. And trust me, they manage around this. Why don't you go to the next slide? And then just some additional quarterly cumulative bonuses. You can get really creative with this, but this can align with your community because you don't want them to just stop where you're hitting those commissions. You want them to be hungry to go more. If you've got the inventory, you want them to try to sell it, but they want to have a goal. And I don't know how these commissions stack up to other communities. I don't know if we pay a lot per unit or if we pay a little per unit, but these numbers motivate my team. You would have to think of it for your own team. And again, I have now in my head from attending that national conference that you want to keep somewhere below 4% for your total program. We know we're keeping it at 2%. And
I have
then
a
later
question for you. I have a
on,
question for you about how you created the percentages. Did you create this out of nowhere? Did you talk to peers? Did you figure this out on your own? Did you do it with your actual team?
so many years ago, when Woodland Pond was not meeting our covenants, our occupancy covenants. In our original bond documents, we had an occupancy covenant. That was our first covenant that we needed to meet before any financial covenants kicked in. As I had indicated, we were supposed to fill in 27 months. So we had occupancy covenants, every month initially for up to 27 months. That was part of the deal for the bond documents. And when we didn't meet those, we did need to bring in a marketing consultant. That was part of the deal. So initially, the commission structure was put in by the marketing consultant that we hired. And that was a protection that the bondholders had. They basically said, if Woodland Pond can't do it on their own, regardless of what's going on in the macroeconomic climate, Woodland Pond's got to bring in a marketing consultant. So the original commission structure was set by the marketing consultant. Then this kind of got tweaked up and down from there. After that happened, I mean, that firm was only in for a couple of years. We were kind of not thrilled with them, and then we just went standalone on marketing, with the exception of the web stuff, which we don't have the ability to do in-house. They do like our digital stuff. Everything else has just been done in-house. Like I said, I literally have absolutely no idea how these numbers compare to any other community. I've never asked the question. Both of my marketing people have never worked in senior living before. So I don't know that they would know if this is high or low or what. They're comparing their result to their result from last year.
Mm-hmm.
Like I said, I have no idea if this is high, low, or indifferent. I'd be curious.
Okay. Yeah.
But I feel like it's probably somewhere in the right ballpark, as I said, because the initial numbers were set by a company that does senior living marketing consulting all over the Northeast. So I think we're somewhere in the ballpark of right for the industry.
Perfect. Want me to keep moving?
Yeah, go ahead.
Okay.
So just go back to that last one
Mm-hmm.
for a second, if you don't mind. So it's also really important to keep your whole team focused on how are we tracking towards those goals. So we use a red, green, and yellow system. So this is always knowing what's in we call it our path file. Again, happy to share this with anybody, but you need to have a tool. This is in addition to your lead management system. So this is something that really our operations, finance, and marketing team use in addition to like reps or whatever you're using for your lead management. Red means it's going to kick a refund. At the particular time that I did this, none of them were going to kick a refund. Green means you can sell it free and clear, and yellow means it's going to send somebody to the health center, and there's other financial considerations. People are really visual learners or users, so you got to have some kind of tool. I'm happy to share this with anybody that needs it, but it keeps people focused. You look down at the bottom right, it says $10,274,000. I sent this to you, I think, in November, and then we got a couple of delays on when we were going to get together. That was what we were projecting to put up in entrance fees for 2022. But everybody, we would meet every week. We would get an updated file. So the marketing team, the finance team, and myself knew exactly where we were trending towards our 2022 goals. And everybody had their eye on that prize. So again, keeping everybody really focused on this. So how did all this work? You can go ahead to the next one. So to the left is 2017. You can see in the top line, the blue line, our occupancy has been strong all the way through. Once we hit stabilized occupancy, which in senior living is typically somewhere around 90%, we've been full ever since. We actually ended, I sent this to you, as I said, I think I sent this to you in November before we were actually finished out 2022. We ended 2022 completely full, so 100% occupied. But you can see that blue line, we've been trending basically full for years. The purple line, very important. So in 2017, we were at 89% high refundability contracts. The end of 22, we were at 16%. So of our new contracts sold in 2022, only 16% were high refundability, and 84% were low refundability. You can see there was a little bit of a blip in 2021. And that's because we changed our marketing strategy in 2021. We needed cash to rebound from 2020 when we had a cash hardship from the pandemic. So we motivated the team to sell high refundability because they had higher entrance fees. But otherwise, you can see that the trends were in line with each other. So we
Michelle,
accomplished that
do you
goal.
have any idea how these percentages compare to your peers in terms of percentage of contracts and refundability contracts?
Only anecdotally, because I was just taking the temperature in the room at the national conference that I was at last year at the Greenbrier there in West Virginia, and just the gasps were enough to tell me that that was something that was different. You can just go back to the last slide, if you don't mind.
Sorry, it's moving
That's okay.
around. It's moving around on me. My
Um,
internet's lagging.
That's okay. The next goal was to maintain a strong incoming entrance fee pool. So even though we were selling low refundability contracts, typically the prices on those are lower, 65% typically on average for the lowest refundability contract. We wanted to maintain an entrance fee pool. So when I sent this to you in November, we were projecting to bring in $10 million in entrance fees in 2022, despite the fact that we were selling only 16% high refundability contracts. And that compared to 10.5 billion back in 2017. So you can see, like, with the exception of the COVID years and then the post-pandemic recovery, our entrance fee pool has remained essentially stable. So that goal has generally been accomplished. But I will say that in 2022, we actually ended up bringing in $12.3 million in entrance fees.
Wow.
So that number is higher than what it was listed here on this file.
Hmm.
So you can do this. And we did that through aggressive price increases. Our market can bear it. We don't have a lot of competition. So we've had an average of 10 to 17% annual price increases on our contracts since 2017. Not every community can bear that depending on your competition. So I do want to just caveat that.
How do you, when you're doing the price increase, how certain are you? How much research do you do? How much price checking do you do so you know that it's not going to end up hurting you 5 years from now?
So we do it on typically on an annual basis. Obviously I have to rely heavily on my marketing team. Our closest competition actually is New York Metro. So we're 90 minutes outside of Manhattan. Sort of kind of a bedroom community-ish. You can get into the city relatively quickly, but the bulk of our competition is in the city, and our entrance fees are roughly half the price of the closest CCRCs in that area. So we continue to have upward, ability on our prices. So we're constantly kind of looking at those rates, and we kind of know where we are. There is some actual limitation in New York State. The regulators will actually look at our pricing analysis to make sure that the margins aren't too great. They do look at that. They look at our comprehensive analysis from the actuarial studies to make sure that the price margins aren't too great. So there's a little bit of cap there, but it's a little bit, they give us some wiggle room.
Okay.
The next thing was to reduce our refundable fee liability. And as you can see, that's the blue line. That has worked. It's gone down 20%. Since we implemented this strategy. So that is a real liability that despite, obviously we've grown our book of business, that liability has come down 20% and our deferred fee revenue has gone up significantly. So that's excellent because that is a future revenue stream. So those goals have been accomplished. And then the last thing for us, and again, we know that our days cash on hand, we know from our benchmarking from our auditors that our days cash on hand is low, but we've known that from the beginning. With the exception of 2020, you can see the trend line here has gone up, up, up. Relative to our peers, this number is low, but relative to ourselves, this number is significantly improved and gradually. We actually did end up finishing 2022 with 170 days cash on hand, not the projected 156 when I sent this to you. So that's significant. So I think, you can do this, but you have to give yourself the time. So it's a good story. And I hope that this inspires some people to tackle this, if you will, and turn their own
I'm
Titanic.
fascinated by it. Thank you so much for being so transparent, Michelle. I want to ask kind of what were the questions that you had, and also the comments you received afterwards. So when you came off stage, it's cocktail hour. Who's the person who came over and said, "Man, I can't believe you shared that. I would be terrified." And because I think that there's a lack of transparency at the financial level inside of long-term care, and I don't know if I don't know if it's because it's lack of experience, fear of judging,
Yeah.
or lining up dollars with lives is terrifying to people. So give me a little bit about what you heard when you came off stage.
So you're actually exactly right. So it wasn't so much when I came off stage. Unfortunately, we had the time slot that was basically like the most hungover, the most people were tired, getting ready to get on their plane. So a couple people got me right after the presentation, but it was interesting. I flew out of Roanoke, Virginia, to come back to New York, and the airport's really small, but pretty much everybody that was in the gate had been at my presentation, and so many people came up to me in the airport while we were waiting for the flight and asked me for my business card and asked me if I could send them the Excel files. But so many said, I'm really impressed that you were willing to like put up there that you started with 115 days cash on hand and that you're still only at 170. Because I don't think I'd be willing to do that. And I said, but it's very important that somebody has to be able to tell the story and say that some of this is just not easy, and be able to say, you can make these changes, and it's sometimes you have to be a little bit aggressive with things. But I will tell you that transparency for Woodland Pond has always been extremely critical, and very important, especially with our bondholders, because it's always sort of been said that Woodland Pond is going to bump along the bottom until we don't anymore. We're meeting our covenants, and a lot of times it's been but barely, but a lot of it hasn't been within our control. It wasn't really within our control as to when we came online. There were issues with financing, there was an environmental lawsuit, it was there were development challenges. Nobody wanted $7 million in construction overruns. Nobody wanted a 72-month fill. But we have to try to control for what we control for now. So I think sometimes it's kind of like being honest about mental health issues or substance abuse issues. Like sometimes you have to tell your story so that others can maybe try to find a solution for themselves in that.
Mm-hmm.
So it's always been our story, and we've always been very public about it. So it didn't really occur to me that others don't talk about their challenges openly
Mm-hmm.
until I was sitting in that airport and several people kind of came up to me and said, wow, I give you a lot of credit for that. So it didn't really occur to me that this was something that might not be for the dinner table, but, it was interesting.
I love the story. Michelle, thank you so much for being transparent, vulnerable, honest, and giving such actionable advice. And I'll put your information in the show notes so any of the watchers, listeners, audience can reach out to you and ask for a one-on-one. Thank you once again.